Well, I'm Gary Sawka, and when Marty says I've been around a lot, I remember the song "Don't Let the Old Man In," and said, if you didn't know, what would you be if you didn't know the day you were born? And I'd say mid 40s, but my wife says, oh no, late 20s. So hopefully I'll be able to have a drink there at the dinner tonight. So I guess I can say for the panelists in the economic forum, whoa, what a difference it would be if you were in Biden land where all you have is happy talk and everything's going to be just fine. So it's only been 2 years now, 2.5 years now that we're in this very room, and Marty had me doing the economic panel 2022, and so I'm also class notes secretary for my MBA class at Harvard Business School, and so I wrote in there at a private equity forum that in the first year, the Biden administration would try to spend all the money in the world, which would juice the economy to unsustainable levels. The next year, there'd be massive inflation and oil prices. And then in the third year, which will be next year, the year of distress. So I'm not sure that's too much different than the other panel there. So let's go ahead and talk about in this case, manager selection. And we've got a nice panel. I think what we'll do first of all is, before I bring up the topics, I'm going to start with the people that are live, and then we've got the two that are in on the screen. So we'll give about a 2-minute introduction. Mine's pretty easy. You can look at my full details on LinkedIn. USC, Harvard Business School, corporate VC, mostly spending the time in highly cyclical and highly leveraged industries, which meant you had to be right all the time. Otherwise, you're going to do restructuring, which I've done a few in my days. So that's my story. So first of all, I'd like to present Maureen Downey, and she'll give her story here.
Thank you, Gary. I'm Maureen Downey. I'm based here in San Francisco. My background is I'm a board MBA. With Goldman for many years in London and Paris, and then I moved back here. I also did my share of leverage finance transactions and a few restructuring. I definitely remember the dot-com boom. Definitely. I moved into private equity in 2007 into the secondary side. And since then, I've done primaries, co-investments, and direct investing. I've done a fair amount of restructuring also on the secondary side. So this is kind of, I feel like, my third or fourth economic cycle right now, if you don't count, I guess, the emerging market ones that I've been in as well, too, because I've also done a fair amount of investing in Latin America, Asia, and in Africa. I currently am a managing director and run our investment alternative team at the Beneficient Group, which is kind of a unique entity that provides liquidity for small and mid-sized institutions, family offices, and ultra high net worth individuals. It's focused on both servicing GPs, general partners, and LPs. And it's a new approach, I think. It's structured not as a fund or asset management company, but rather a trust bank. And so it has kind of a unique structure, and I can elaborate offline more about that.
Okay, so then next up we have the second most famous Vladimir. In this case, Vladimir, maybe that.
Vladimir.
Vladimir. Okay, so close enough for government work.
No, that's the guy in Ukraine.
Vladimir.
He's the second most famous.
Belinsky, and he's Hermitage Advisors, which takes the name from a real famous museum. So why don't you go ahead and give your spiel?
Great, thank you. Can everybody hear? Good. So I'd say there's three main aspects to my career, which have really helped in being able to find my way to managers and selecting them. I started my career manufacturing, managing, and marketing investments, from mutual funds to virtually every type of private equity and alternative investment. And I started that in 1983. And that led me to being attracted to Ashbridge Investment Management, which was the family office for the Bethlehem Steel family. And we did the same thing. We not only invested with managers, but we also manufactured our own investments. And all of that experience led me to be my own boss and start Hermitage Advisors.
Okay, so now we've got some Zoom people here. We talked yesterday with Chip Perkins, who lives in the great state of Maine, which actually was one of the first states 200 years ago to get out of succeed from Massachusetts. So Chip, why don't you give your story?
First of all, I only live part-time in Maine. I'm an official resident of the state of Florida, in case anybody from Connecticut is out there.
A little bit louder
can't
now.
hear
You're
that.
gonna have to speak up.
Well, let's see if we can do that. This thing's pretty cranked up, I'm afraid.
That's better.
I think they need to crank this up.
All right. So anyway, my name's Chip Perkins. I am a placement agent. My firm has been in business for 25 years. We've raised in excess of $7 billion for the managers that we represented. We are a broker dealer. All of my reps are registered agents. We take on 5 to 7 non-competitive managers at any given time. And primarily we work in the hedge fund industry. We do deep due diligence, on-site visits, analyze all of the data that they provide, their audits, etc. I can be reached at www.pfm-llc.com or just look me up, Chip Perkins on LinkedIn. Happy to have a conversation. Danye, it's your turn.
Yeah, Dania, go ahead. Looks like you got a background. It's a little unstable. Where are you?
Hi,
Here.
greetings from Japan. I've been
Okay.
traveling in Asia. Can everybody hear me okay?
Yeah.
Yes.
Okay, awesome. So my name is Danye Wang. I spent most of my career with BlackRock before coming out and start my own advisory firm and multifamily office called UniGlobe Capital. My role with BlackRock back in the days were very focused on international institutional relationships, both with Asian institutional investors and especially sovereign wealth funds across the world. And from an asset class exposure and coverage perspective, and everybody knows BlackRock is an asset management supermarket by now. So my coverage ranged from fixed income, traditional equity, passive, active quant, to alternatives, real estate, hedge fund, VCP, etc. So UniGlobe Capital started about 3.5 years ago, initially trying to bridge the gap between institutional investors, both from the US as well as Asia, and investment opportunities globally. And in the most recent year and a half, I really focused on working with a few high-profile Asian families from China, Hong Kong, as well one specific Indonesian family on their specific North America exposure. And most of my work were around venture capital. Previously was also looking into growth equity, also recently be more cautious given the valuation correction, as well as private credit and crypto Web3. I'm happy to discuss all those fronts.
Well, I'm glad you mentioned BlackRock because a couple of years ago, we were walking out of SF MoMA and I had my Brooks Brothers suit on, which is one of the few that still fits. And a couple of BlackRock associates came up to me and said, "Are you Warren Buffett?" And I said, "Jesus, that's a pretty nice comment you made." You know, and my wife was really happy and stuff. But then we went up to the dinner and turns out one guy says, "Do you know Warren Buffett is 90 years old?" So maybe it wasn't that good of a comment. So I don't know if they were real smart or real observant or whatever. But the first topic we'd like to talk about is the environment for managers and whether the family offices are considering manager portfolio changes given the pretty dismal year for all asset classes, whether it's Dow down 20% or NASDAQ down 30% or Bitcoin down 50 or 60% and NFTs maybe 80 or 90% if they still have some quotes these days. So I think the way we'll handle this, so I can give everybody a roundtable, is probably a couple minutes on each topic. If somebody has a really good comment, just go and interrupt. But I think I'll do it in the same manner as we did the first introductions, okay? So, and I know you guys are on the screen. The next time we'll shift it around so you don't feel left out. So Maureen, why don't you start off with that?
Okay, I guess I'd maybe put the question back to you, Gary. Do you want to talk about private managers or public asset managers? 'Cause
Well,
I think
well,
it's
both, you know, just in, you know, like, you know, from all the football I'm following from USC, you know, guys are getting pitched out after 2 or 3 games. You know, the transfer portal's in, so guys are changing, you know, every year. You can't even tell who the player was. So, you know, what's happening there? And are really your managers seeing the dismal performance? Are they worried, or are they in, you know, the happy days of you know, what we said, Biden land, where everything's going to be okay? So
Yeah. I'm kind of actually looking back like 20 years, because I remember kind of what happened in 2000, 2001, too. We're kind of in a very different space now. I'm just going to address the alternative space. So private equity, private credit, and venture capital. I think if people remember back, before the 08 crisis, you had a lot of really big buyout funds that raised a lot of capital in 06, 07, 08. Those funds ended up doing okay, but they got to a point after 08 and 09 where some of their equity positions just went negative because they had so much debt. And so there were a lot of institutions that were selling out of them just because, you know, for instance, if you're a foundation or an endowment, you needed capital and you couldn't necessarily get it from your public side of your portfolio. So people were actually selling private equity assets, and other folks did other things to raise capital. But I would say that I saw a lot of very interesting valuation approaches, and I'm kind of anticipating we'll probably see that. A lot of managers switch from doing multiple valuation to, like, you know, DCF valuation. But the bottom line is yet those say buyout funds didn't perform particularly well, but they did eventually return capital, and they did return capital at like a 1.3 or 1.5. But what happened is that they did have lower IRRs. Now, but you kind of almost have to have a flight to quality. So I kind of think of it as in the top quartile, you know, top of the second quartile. And once you get to the bottom of the second quartile and into the third quartile, that's when you start to have, I think, some issues, and you may want to take a look at those managers and figure out if this is essentially a franchise you want to continue with. Because one of the things that does happen, I think, after a big economic cycle, especially if the manager hasn't done well in their last fund, and maybe the fund before that wasn't that great, is that they will struggle to raise another fund. And then you have a situation where you have a manager who's trying to keep their franchise and their team together, and they may not be able to raise in their fund. So usually in that situation, you have a manager who kind of extends out, you know, the existing fund lives of the assets that they're managing. And that's where you've seen also the phenomenon come up in the last, I would say, dozen or so years, what we call GP fund restructuring, which is not necessarily a bad thing, but it puts a different dynamic in that for that manager versus a manager that's been able to perform consistently at the top of the second quartile or in the first quartile. The other thing I would kind of make note of is that if you had the gumption and the capital to invest in 2010, 11, and 12, those are some really great vintages. And so those vintages from a primary perspective have done, you know, very, very well. It's such a massive topic here. I mean, I think the biggest question, if I were looking at my portfolio, would be to say, what are the managers that I think are going to be really good at managing through this cycle, that have enough cash, you know, left in their funds to support their portfolio companies, and of the portfolio companies that are in their funds, do those companies also have enough support in the syndicate? So a lot of times when you're investing in a venture manager, even a growth manager, they're not the controlling GP. And so one of the things I've also seen happen cycle after cycle is that you may have a really great asset in a fund, but the other folks around the syndicate don't have the capital to support it. Now, it's obviously a much deeper and broader market, and you have a lot of secondary players that come into play here. So it's not to say that it's game over, but I just think that you need to be more cognizant of looking at not only the quality of the manager, but of the assets that are really driving the return in the fund. What's that syndicate like? And also, the other thing that I've seen kind of interestingly is a lot of venture funds that are about 5 to 7 years out in maturity, who had really great marks and valuations in the last couple of years. Those valuations are going to come down. I think managers are going to be reluctant to have those valuations come down, but they will. And the question is, you know, if you were thinking about it strategically, would you like to try to take some money off the table, maybe be selling a part of those funds or some of those assets? I mean, there's a lot of different ways, I think, to look at portfolio rebalancing and liquidity. I think one of the challenges a bit for smaller alternative investors, so not the big pension funds or foundations, is where do you go about getting that liquidity and getting a good price? So just those comments.
Okay, so that's good. So Vladimir, we're looking now
Same
at the
question.
same question, but maybe a little bit of a twist. So a lot of the millennials are looking to inherit a lot of money these days. Are they getting concerned about their parents' money getting, declining, and maybe they won't be able to buy a distressed sale of a Russian oligarch's yacht or a nice a big house in Monaco? What do you see there?
Well, first of all, I can't imagine an investor or a family office that's breathing and has a pulse that hasn't been concerned about what's going on in the liquid markets. I mean, they're down a lot. And the managers that invest in that space, if they're good managers, and I think a lot of them are pruning their portfolio and doing whatever they can to survive in the market. Unless they're a hedge fund, then they're pretty much long only. The only way they can hedge is with cash. And so that's the reality there. And in the private markets, I mean, you're in for the ride. So what's going on right now in the public markets, I don't want to say it doesn't matter, but there's not much you can do about it. Once you've made your investment, then you have to manage that investment through its full cycle. So with millennials, and this is actually an interesting topic for me, at Ashbridge, the people who were at the head of the family were second generation. And you had the third generation coming of age to be able to get baked into the process. And then, of course, the fourth generation was in the oven baking. And so I think that you have to bake these people in early and develop a decision-making process and understand that this is what happens in the markets. You can go back to 2020 and we were down 37% in a few days. And then what happened, right? In April of 2020, the market took off on one of its strongest runs for a year and a half in history. And so how do you go to an investor and say, we got 30 million people unemployed, the economy has fallen off a cliff. Geez, I think it's time to put money to work. And the point of that is that it's very difficult to tell when to be in or out. And the way to deal with that is upfront. Account for that in your overall asset allocation. Account for that as part of your investment process. And when it happens, all you do is tweaks rather than a complete rebuild. Because if you're doing a complete rebuild, you're going to probably compound one mistake over another. But everybody should be concerned about the decline in their asset value. And I don't think millennials are any different. I think they should get involved. They should learn the process, learn the business. And if they're going to be part of the family office decision-making structure, then, you can't start too soon. And the older people in that family office should be bringing those people along and make it a collaborative effort, because they're eventually going to take it over anyway.
So Chip, notwithstanding the fact that I'm only in my late 20s, I do remember the market from 1966 to 82, where the Dow didn't go up. I don't think there was a NASDAQ then, for something like 16 years. And, you know, real estate, where I think the Empire State Building was built in 1929, didn't get fully leased till 1955. Do you see, in terms of the managers, that everybody still thinks everything's going to be okay, if not this year, within a year or two? And so it was just sort of like a bad dream? Or do you think that there's some people kind of looking at our earlier economic panel, which perhaps you listen in, to think, hey, maybe there's going to be a much longer period of, you know, instead of stock market winter or private equity winter, along with the crypto winter?
Well, I think that families have a long memory, maybe not as long as yours, but many do. And I think that people are still looking for opportunities. You got to remember that most family offices are not in the get rich business, they're in the stay rich business. So they continue to look for opportunities, and not looking over their shoulder all the time. I mean, there's not a lot of activity this year. Not a lot of people are putting money out, but they're looking. But they're looking for something different. They're looking for niche strategies. They're also looking for, macro is very popular this year. Obviously, they're doing well. But, you know, we have people that are looking at things like electricity trading, and different kinds of arbitrage in cryptocurrency, trying to find niches and be light on their feet and able to enter into different markets versus standard long short equity or long short credit or whatever it may be. And again, I work primarily in hedge funds, not that much in private equity. So I don't know who's talking there, but picking it up. But, you know, I think that people are going to wake up to the fact that private equity guys do not mark to market. And they're going to be unpleasantly surprised, I think, with a lot of their managers in the 12, 14, or 15 years after the 8-year fund comes to fruition. So I think that I don't think this is just a hiccup in time, but I think it's an adjustment that's taking place both in the private and the public space. But I think people want to find new things to invest in.
Okay, so Dania, you're in Japan, and despite our panelists talking about Japan being in a 30-year economic recession, it's still a pretty rich country by most standards, and, you know, a pretty nice place to live. You know, you can go in public transportation, the train station, you don't see some guy swatting an imaginary bug, or, you know, cursing out loud, or, you know, doing his business in public. So maybe you could give us some ideas of what's going on in Japan in terms of some of the managers, because I know you've dealt with managers all over the place, and how they view Japan and the rest of Asia, which of course you get very involved in, versus maybe some of the US-centric comments we got here today.
I would love to comment on that more broadly from an Asia perspective. I just arrived in Japan, and I'm yet to catch up with a few managers and startup opportunities here. But I did just spend 2 weeks in Singapore, as some of you know, for Super Return Milken and Token 2049, since I both look at traditional venture capital as well as crypto. So definitely a lot of interesting insight there. But broadly, I do want to say, for any one of us who work with family offices or any other institutional types, it's important to understand our end clients' objectives. When I was servicing central banks, we always say safety, liquidity, and then return. I actually had a lot of interactions when I was in Singapore with a bunch of sovereign wealth funds from Middle East, regardless of what's going on in China, for example, as some of the regulatory and political uncertainties, Middle Eastern sovereign wealth fund, given their size of capital and given they have to deploy in large scale, either managers or direct deals, they just have to allocate to China. They have already invested a lot in North America, and when they think about investment opportunities globally and which markets they can go into that can accommodate the sizes they're willing to deploy, and for each manager and each opportunity is typically over $100 million, and it has to be China, given it is one of the biggest capital markets. So I give that example just to put things in perspective, and there are Chinese family offices that have accumulated most of their wealth in US dollar and may have historically deployed a lot of capital in China and still maintained a large operating business in China. However, in the most recent year or two, and they come to realizations that they need to achieve global diversification and need to make sure their US dollar assets stay in US dollar opportunities, which is part of the reason they come to people like me to really focus on developing and providing access to their global portfolio with a focus on North America. So truly understanding your family and clients' objective is part of the realization I want to share. And the other thing is that the other few panelists all commented on the more complex geopolitical risk and macro economy. And I think from a family office perspective, people can't just look at investment opportunities from a bottom-up perspective anymore. They have to think about top-down. They have to be more politically aware, more macroeconomically aware. A lot of asset classes are unfortunately achieving a lot of a higher degree of correlation. Even if we think about crypto as an asset class versus public equity, there's a lot of correlation as well, although a lot of people may not be previously aware of that. But just really quick, I would say there were 4 things I noticed, especially from an Asian family office perspective, and the sentiment and the mandate had kind of changed in the most recent half year, 1 year. One, the first thing is a more of an interest on smaller managers instead of purely brand name managers, because they can achieve access to, say, my former employer, BlackRock or Blackstone, KKR, Carlyle of the world, or even like Andreessen Crypto Fund through private banking relationships. But when they think about niche strategy or more interesting and differentiated managers who really want to work for them from a return profile perspective, they have to think about smaller managers and emerging managers. And the second realization is that family offices are more interested in how managers think about portfolio construction and pace of investment. What we observed in 2021 is that a lot of people were deploying capital a little bit too aggressively. And even in the beginning part of 2022, there were managers who really captures the market, unfortunately, with a much higher valuation, and they have limited dry powder now, given valuation have significantly came down. And the third thing is that the appetite for newer asset classes. One example is private credit. I exchanged notes with some locally based Singapore or Hong Kong based family offices. Private credit historically was very known to, say, Taiwan investors out of Asia, but it was not as much of an asset class to most other Asian investors, maybe with the exception of Korea and Taiwan, as I mentioned. So a lot of family offices realized private credit as an asset class offers shorter duration and lifespan of investment, but private equity or even venture capital like return profile. So a lot of family offices have become very interested in this asset class, but don't have the skill to truly evaluate this type of managers. So that is also an area. And the final thing is that I think family offices also come to realization that they need to depend on managers' access and skill to achieve longer term asset allocation and more consistent and stable return profile, instead of only looking at deal by deal and only looking at direct deal themselves. So that are the four things I kind of realized from an Asian family office investment appetite and approach changes.
Okay, we got a lot of questions. I'm going to let you catch your breath or there for a little bit. And I think I'll go back again, the same thing with Maureen on this question. You've actually, talked about this. Okay, we got a question. Okay.
Maybe you can repeat it. But my question is, can you talk about how analytical the Asian family offices are? Like, it's a new skill set that they're adapting in terms of investing in alternatives. Is it an old that they've had? It sounds like she said earlier that, they may not have the skill sets in-house. And what steps do they take, et cetera?
Okay.
She talked about the velocity of the investment.
Yeah.
Right. So can you repeat
So,
that?
obviously, analytical methods and duration and risk profiles change a lot. Marty was asking the question about in some of these new alternatives that, like you talked about private credit, whether the Asians are in particular looking at these in a different way. Do they have the skills to analyze it, or do they bring in analytical talent, or somebody like yourself who've, worked a lot in the United States to help them out on getting smart in those areas?
I would say it's still a huge gap from a talent perspective, although a lot of the sophisticated and larger single family offices have hired a lot of international returnees who are well-trained in asset management firm or historically have worked in endowment foundations, so operated as LPs themselves and have the analytical skill as a background and experience. However, I still think depending on the asset class we're speaking about, there's a significant lack of data. It's not necessarily an issue for Asian family offices. It's probably a challenge for the industry globally. If we're talking about venture capital, for example, and especially if we're talking about emerging managers, it's not just about existing track record. It's not just about MOIC or IRR or data that you can analyze. A lot of the evaluation is also qualitative, which means that reference checks and the ability to talk to peers and other people who have been there, done that, had previous interactions with a certain manager also become very important. And if an Asian family office doesn't have their CIO or their investment team members who are already in the international ecosystem, it's very hard for them to conduct due diligence. So I would say another reason on top of data and analytical skills that they would rely on some international partners is also to rely on people's resources and ecosystem and personnel relationships to be able to conduct reference checks and be more certain about someone's reputation and the actual quality of the work that person or that team has previously done.
Okay, so that's a good answer. And I guess the Asians do have an advantage because, if China decides to invade Taiwan, then, they got something like 90% of the semiconductor chips are there. So I guess they have an advantage that they know how to use the abacus, and that's a few of us older folks here still have their slide rule. So they do have, but that is a serious problem if that happens, because all things will stop except really old cars. So I think I'm going to let you rest for a bit while we go over to Maureen. You've talked about a lot of this already, but benefits of the portfolio construction and liquidity in choosing managers. Maureen, when we had a pre-call, some families have liquidity needs, some maybe for calls for private alts and others that they didn't know they had, and now suddenly, need liquidity. But let's just talk in general about that, and also the families. Of course, some of them, are they changing their portfolio construction now because they think there's opportunities? So why don't you just comment briefly on that, and we'll go on through the rest of the panel.
Maybe just a step back. Family offices have been investing in private equity for a while. They've certainly ramped it up. I think they kind of approach it a little bit differently than institutional. When I say institutional investors, I mean like pension funds, endowments, and foundations. In part because family offices pay taxes, right? And pension funds, endowment foundations don't pay taxes. And also too, there is sometimes a staff differential, like you have more people to help you sometimes in bigger institutions. Danya mentioned, and I've worked with sovereign wealth funds as well too, that they don't really get out of bed unless they can write a $200 million check, right? And that's not going to be necessarily the same thing if you're at a family office and you're looking at a $2 to $20 million check. One thing I will say in this kind of environment, and when you're thinking about portfolio construction, is what are your liquidity needs? I've had some interesting conversations in the last 3 months with some of the big endowments who are extremely thoughtful about how they're doing their portfolio construction, because none of them want to be caught out like they were back in 2008, because 35% of their university's operating budget is satisfied by that endowment portfolio, right? So I think it's I think a little bit different depending on the nature of your institution, whether you pay taxes or not, and also kind of what you think your liquidity needs are going forward. Now, I'm going to differentiate a little bit between what I'll call like the pension funds, sovereign wealth funds, and endowments and foundations, and maybe say family offices and ultra high net worth entities. What you found is that over the last 30 years, but in particular the last 20 to 15 years, the secondary market in private equity has just grown tremendously. I mean, now about 8 or 9% of the overall volume of assets that are raised in the private market turns over. This 20 years ago was like 1%. So it has completely changed. And also too, they're not just doing buyout stakes or growth stakes. They're doing venture capital. There's dedicated infrastructure and real asset funds that are doing secondaries, and there are also private credit funds. So what does this mean? This means that if you are an institutional investor, it's just grown tremendously. And that means you're more comfortable that if you do a portfolio, go ahead.
Is that annual turnover?
The way it's been calculated is like what's raised in 1 year, right? They expect that 9% of that will turn over in any 1 year in the secondary market. So it's grown a lot. But about 16 firms worldwide do about 80% of the secondary volume. So it's really concentrated at the top end of the market. So if you're a sovereign wealth fund, or if you're CalPERS, they just divested $6 billion out of their portfolio. If you want to sell 100, 200 million, no problem. All the bankers who got laid off in 2008 went to set up secondary shops. So there's a whole industry right now that are the intermediaries. So if you are on the board of a public pension plan or endowment or foundation, you're by nature, you have to go out and actually use an intermediary. You have to hire a law firm. And so it's actually a fairly complex process, but if you have a lot of assets, it makes sense. You know, it's an economy of scales. I've actually done it myself and sold a lot of assets. Now, when you get down to the family office space and ultra high net worth space and smaller and mid-sized institutions that may be covered by a consultant, it becomes a little bit more challenging to do your portfolio rebalancing. And I would say most people, Vlad made a comment that, when you go into alternative assets, you got to kind of ride the course, and sometimes that course isn't just the 10 years or 12 years with the extension. It can be like 15 or 16 years. So I think what the industry needs and what we've been trying to build, and it's coming, is a chance for you to actually rebalance your portfolio if you are a family office or high net worth or a smaller or mid-sized institution. And that's coming. It's not, though, at the same level or the same size as you see servicing the large LP market. But the more you get that secondary possibility, the more I think you'll have that investor class, family offices, ultra high nets, come and start investing even more into alternatives. You're also seeing, if you look at the TPGs, the KKRs, iCapital is another firm associated with BlackRock, the biggest and the largest growing class of investors coming into alternatives are ultra high net worth and family offices, because the defined benefit plans aren't growing anymore and we're not getting new defined benefit plans. So if I am one of the large institutional investors or GPs out there, I have to go to ultra high net worth investors. And also if I'm a big asset manager, if I'm Wellington or if I'm Franklin Templeton, I want to go to that class because I can charge a lot more for that product than I can for a public. So the last thing I'll leave you with, it is coming, and I can expand. I don't want to take too much more time, but the other thing that family offices and ultra high net worths are not are subject to, that institutions are not, are what we call like the 3 Ds, which is death. Somebody in the family dies and you need to reallocate the assets and you need to get a valuation. demise, which we saw during the COVID, like if you were a family and a lot of your wealth came from the hospitality industry, you had to basically get liquidity back to support your business. And so we saw people trying to liquidate some alternative assets to kind of support their family business. And then the one that nobody likes to talk about, divorce, which actually drives a lot of sometimes having to split and sell, private assets in order to do that in the settlement process.
So I'm looking at our time here, Marty, and I think I'm going to ask us the next question along with this so we can rotate through. And that has to do with private alts and public alts and really valuations and really guys that are going to have to be called. There was an article in Barron's about a guy says he has a 20% allocation to alts, but he didn't realize he hasn't been called on and will be called on now on something that's well underwater. So that's a pretty bad situation. We got to keep ponying up a lot of money. So and then he talked about the UK and the gating there. So maybe you could comment briefly on that because it's a subject that I know Marty wanted us to cover here. So let's go ahead with that.
Actually, that kind of falls into your whole secondary perspective too, right?
Yeah.
Yeah. So I kind of think of secondaries and people who do it can be very creative, right? Because at the end of the day, what you're really talking about when you're looking at assets sometimes and trying to solve for liquidity issues is kind of a sharing of cash flow. So it doesn't necessarily need to be an all-out sale. And what I've seen in the past before, whether it's kind of a larger family office or even institutional, I'll sometimes ask them, and I said, well, what's your exposure to alts? And they'll say, oh, it's 20-25%. I'm like, well, is that your NAV or is that your total capital commitment? And they'll be like, well, actually, I'm 37%, exposed to alternatives. I'm like, well, in times like this, and I will guarantee you that no manager is ever going to give you the capital back. They will call that capital. And where I've seen the pain point come is where you don't have a lot of liquidity from your public assets and you're not getting the distributions back because the alternative asset managers aren't being able to sell or exit, right? So you're not getting the distributions, but because valuations may be going down, they're calling the capital to put to work. And so what happens is that you have a real lack of liquidity. Now, if you don't make your capital call, then you forfeit your stake in that fund. And so that's a real pain point. And what I have seen is I've seen basically entities take loans against their private equity portfolios. I've seen or done a construction of a special purpose vehicle where you can put all the assets into the special purpose vehicle and you can do what I would call a sharing of cash flows. So the secondary participant might meet all of the capital calls for a certain period of time. And then in exchange for that, takes a preferred cash return off the portfolio. So for instance, and you can do this with a fund itself. I've also done it directly with a GP too. But it's a way for, if I'm a liquidity provider, I come in, I see that there is a collection of assets here that can be my collateral. I will then make those capital calls. And in exchange for that, I will take a preferred return up to a certain level that I get my capital back. And then we will share the cash flows in a percentage way going forward. So it's kind of a very much of a win-win scenario. I've also done this with GPs directly. So for instance, you are fully called on your fund and you have a number of assets. Some of the assets are over levered. They need to refinance their balance sheets and there isn't capital in the portfolio or they need additional capital to support them. You can come in as a secondary buyer and you can buy what they call a strip across the portfolio. You subordinate the existing LPs, but if they didn't get the additional capital, they would probably be getting a 0.9 back on their fund. But with your additional capital, they'll get maybe a 0.2 or 0.3 back. But as a secondary buyer, you ask for your capital back plus a certain return. So there are many ways to do this. I think the issue comes down to working with somebody who has the creativity to figure out, okay, what are your pain points that you're trying to solve for? And then, here's the tools that I have, and let's see if we can come up with something interesting. I mean, in the last, I would say 10 years in particular, there are many players out there and people that can help solve liquidity issues. And it's a positive because the more I think solutions you potentially have out there, the more comfortable people feel committing capital to the sector because they know that they're not hopefully stuck for the next 10 to 12 years in an asset without any choice of liquidity.
Maureen, you were definitely the first one to ask because you've got such a comprehensive answer. Now you've made it hard on the rest of the panelists because how can they add to it? But Vladimir, once you add any other comments on that as we're rounding the curve in the last 5 or 10 minutes.
Sure. I would say if you have liquidity issues, you're going to go through a lot of brain damage. And you've got to account for that upfront. You either got bad advice, or you didn't listen to it, or you made foolish decisions, or whatever it is, hubris, you name it. But if you build your portfolio right, you account for all of the stuff that you need to account for in order to manage that portfolio through thick and thin. And if you've gotten into a situation where you got a liquidity issue, I would call Maureen because she sounds like she knows all the places to go to figure all that out. But the emotional toll, the mental toll, the financial toll on you is tremendous, and you're better off accounting for that upfront. And when the cycles occur, and we're always going through one type of cycle or another, you're prepared for it. And it doesn't mean that you're not going through some pain. You are, but it's not like you're being forced to make decisions at a stress point that is just going to be uncomfortable. You don't win very much in something like that. And so, I would say you got to solve for that up front. Because by the time you get to it, too late.
Okay, so Chip, let's go ahead with your comments here. So Chip, your comments will be received better if you turn up the mic. It seems like a lot of people can't hear you.
Well, I had to take it off mute, first of all, because I didn't want to interrupt anybody. Secondly, I'm not an analyst. I think they've all had some great answers on that. I don't really have anything to add to that. My position is one of finding good managers and presenting them to families, and they've got to make those decisions on their own. That's not, kind of what we do. Danye is much more experienced, as are the other panelists, in helping families make those decisions. So I decline to answer anything else.
Well, that's a good answer. Danya, you've had a lot of experience, especially in people that have, obviously done something pretty smart, and that's get assets out of China and put them someplace else where, they won't be subject to the whims of the government. So maybe you can give us some comments on those ideas.
I have personally not been in the business of helping people to get money out of China. I work with family offices that essentially already have a sizable US dollar book. They're historically have been entrepreneurs who have built family offices who essentially brought their company IPO in Hong Kong or US stock exchange. So most of their wealth creation has been in US dollar. And there were also real estate families who have moved a substantial portion of their asset out back in the days before the regulations started cracking down on capital control. So I really only work with family offices who have already have a large percent of their asset in offshore asset. The other thing I do want to say is that there's an interesting trend of GPs who have built a very successful business in China for the past decade. I meant US dollar GPs, and on this I'm commenting on the Hill House, the Sequoia, the Qiming, the Matrix, the Gaorong source code, many of the managers that you guys have also come across. And there are some of the smaller GPs that may not known to all of you, but at least in the China landscape, they're also quite reputable. And many of them have started family offices in Singapore recently. There is a new regulation in Singapore that essentially require any single family office to at least have 20 million ready to go, and a larger scale single family office will be 50 million. And there's also local hiring requirement for these people to start family offices in Singapore. So it has become very vibrant, and I feel like for anyone who wants to pay close attention to family office landscape in Asia across the board, Singapore is definitely a country where we should spend more time on.
Okay, so now I see Marty standing up, which sounds like it's next to the panel. So unless, Marty, you've got some chat questions